And straight on to our top story, it's yet another setback for the tax department over the transfer pricing case. The Bombay High Court today has ruled in favour of Shell India in connection with the 15,000 crore rupee transfer pricing case. Just last month, Vodafone also won a 4,500 crore rupee transfer pricing case. First, let me give you a quick background to this case. In 2009, Shell India issued 870 million shares to its overseas subsidiary, Shell Gas BV, at 10 rupees per share. Now, the tax department contested this valuation and pegged 180 rupees for each share, thereby adding the difference of taxable income to Shell India. Now, the High Court has declared that share issuance by Shell India cannot be deemed as taxable income. And Menka Doshi is here with us, and joining her, she has with her Mukesh Bhutani, who was the lawyer for Shell India. Menka, over to you.
All right, thanks very much for that, Kritika. This is an important decision that's come in. It's come in on the back of a similar decision in the Vodafone matter, which went through similar facts, if I may say so. And in that case, the Bombay High Court had ruled that such a difference in share valuation cannot be considered a deemed loan, therefore cannot be added to the income under transfer pricing rules, and hence is not a taxable event. Let's get to Mukesh Bhutani, who is the lawyer of Shell India. This is a good day for him. Mr. Bhutani, good afternoon. Thank you very much for joining us. I want to start by asking you first for what the details in the verdict were, because the written order is not out as yet. So if you could just talk us through what the High Court bench had to say.
Well, the High Court essentially followed the Vodafone decision, in which case it was held that the tax department does not have jurisdiction in a situation where an Indian company issues shares to its foreign parent, and if there is a difference between the tax department and the taxpayer insofar as valuation of those shares are concerned, then those differences cannot be brought under the transfer pricing law, because in the first place the tax department erred in exercising its jurisdiction, because at the end of the day it's a capital account transaction. So today the Bombay High Court followed the said principle that it had laid down in Vodafone's case and held that it has to be followed in Shell's case as well.
Mr. Bhutani, it was expected, even though the benches were not the same. The Vodafone decision was decided by the Chief Justice's bench in the Bombay High Court. One justice was common to the Shell decision as well, Justice Sanklecha. But it was expected that the Shell case would go the Vodafone case, that is against the tax department. Yet there is a twist here, because the Revenue Department, as you told me, attempted to distinguish this case from Vodafone on 4 factual grounds. Very quickly and in very simple language, if you can explain to us what the Revenue Department was attempting to do and why it failed.
Correct. So those were the 4 facts that the tax department's counsel brought out to the notice of the honorable bench today. Number 1, unlike in Vodafone's case, Shell had not disclosed this as a transaction in its transfer pricing compliance. Number 2, Shell had taken the writ route as an alternate to the plea that it had made to the dispute resolution panel, whereas Vodafone had not taken this as a remedy under the alternate remedy. Number 3, as a result of the manner in which shares were issued by Shell India to its overseas subsidiary, there were multiple shareholders, whereas in Vodafone's case there was only one primary shareholder. So the tax department brought this to the notice of the honorable court and argued that the facts are independent, and hence the matter should be sent back to the dispute resolution panel. The High Court negated that view of the tax department and said the facts may be different, but the larger principle that has been laid down in Vodafone's case still applies, which is that you're simply dealing with an issuance of share transaction, and that is not dissimilar in any manner in Shell's case, and hence the said principles should apply.
You iterated 3 distinctions that the Revenue Department attempted to make. Was there a 4th one that was material as well, or can we skip it?
No, that was not a material distinction that has been brought out, but I think these were the 3 material ones.
Okay, the reason why I'm asking you for so much technical detail is simply to try and understand whether the other almost dozen cases where the facts are similar, if I may say, not same, would get similar relief now that both Vodafone and Shell have become precedents in terms of how the Bombay High Court views such transfer pricing tax attempts?
The answer is simply yes, because we also did not have any doubt that the Bombay High Court's verdict in Vodafone's case simply stated that it is a case of an Indian company issuing shares to its foreign subsidiaries. The transfer pricing law is very clear that you can carry out a transfer pricing adjustment only if there is an income arising from an international transaction. And there can be no case of an income arising out of an international transaction just because there is a dispute insofar as the valuation is concerned. So the Bombay High Court, like in Vodafone's case, took a view on the preliminary question of jurisdiction, and it did not bother itself to get into aspects of valuation. When the preliminary issue itself was decided against the tax department, the valuation aspects are secondary in my view.
So all similar such matters will benefit from the fact that the Bombay High Court has yet again, in the principal matter, decided that such a situation is not a taxable event. Yet I want to add the one last twist, which is that as yet Revenue has not appealed the Vodafone case to the Supreme Court. It could very well do so, and the same could apply to Shell. So this may not be the ultimate decision, maybe only the penultimate decision.
Well, that's for the government to decide whether they want to appeal against this decision or not. But you're right, they certainly do have the right to appeal this to the Supreme Court, and then the Supreme Court will take a call.
All right. So as of now, just to take a quick view away from you, Mr. Bhutani, on what this means, for several MNCs operating in India, they will find certain relief in being able to capitalize their Indian subsidiaries, knowing that the Bombay High Court does not think that the valuation of that could become a transfer pricing dispute.
Well, I think the taxpayers, the multinationals and the tax experts had no doubt in their mind that an issuance of share transaction can never give a rise to a transfer pricing adjustment, even if there is a difference in the valuation as alleged by the tax department and as taken by the taxpayer. But I think certainly this puts to rest the entire controversy. Bear in mind that all of these adjustments took place and they were subjected to jurisdiction in Mumbai. At least I'm not aware of other multinationals who have faced similar transfer pricing adjustment in other jurisdictions. But I think it puts to rest the controversy, at least insofar as the Bombay High Court verdict is concerned, unless the Supreme Court comes and reverses the Bombay High Court decision, which I don't think is possible, or there is some kind of an amendment to the law.
All right, Mr. Bhutani, we'll leave it there. Thank you so much for joining us. I know it's a good day for you because your client won, but let's see if this matter does end up in Supreme Court. With that, Kritika, as you can see, this is good news for lots of multinationals who are hoping to be able to continue to capitalize their Indian subsidiaries without having to run into transfer pricing issues. At least at the Bombay High Court level, they seem to have won. We'll see how this matter progresses.
Absolutely. On that note, let's take a quick break then. Japan's Prime Minister calls for snap elections next month.